to our Vice President of Servicer Relationship Performance Management, Don Griffin. Don?
Thanks, Baha. Welcome, everybody, to the Servicer Information Session for COVID-19. We've had some bulletins published this week, 2 bulletins in servicing, so I'm going to turn it over right away to Ryan McGinnis from our Servicing Policy Group to give you some updates from those bulletins. Ryan?
Thank you, Don, and thanks everyone for joining today. We're going to cover the 2 bulletins that we issued this week. The first that we will cover, Bulletin 2020-28, was specific to eligible disaster policy as well as COVID-19 related policies. So for eligible disasters, we had 3 topics that were entirely specific to disaster situations. So the first one is the introduction of the Disaster Payment Deferral, which will become mandatory effective on October 1st, 2020. And really, essentially, this is the payment deferral, just like what you saw us introduce for COVID-19 impacted borrowers. We're moving that also into the disaster space with some minor differences just to account for the fact that it is disaster and not COVID-19. But it works pretty much the same way, where a borrower who has an eligible disaster-related hardship and who was current or one payment past due at the time the disaster occurred would potentially be eligible for the disaster payment deferral if they, can't afford to reinstate by more traditional means, but also don't require payment relief. So I think most of the attendees on these calls have probably talked to us at length about the COVID-19 version of the payment deferral. Again, this is the same concept, just to be used for disasters. So I'm not going to get into too much detail on that right now, but we'd be happy to address any questions you might have about what you saw in the announcement or anything to do with the disaster payment deferral concept. The only other thing I will note is that the disaster payment deferral is replacing the existing options that we have in our disaster hierarchy that essentially do the same basic concept that are designed for borrowers who can afford to maintain their monthly payment but can't afford to reinstate and who don't need additional assistance. So the extend mod and the cap and extend mod will be retired no later than October 1st, but the earlier of your implementation of the disaster payment deferral or October 1st. So we do think that the disaster payment deferral accomplishes all that those 2 programs together accomplish and more. It's a better outcome for us, better outcome for the borrower, and hopefully a simpler outcome for you, the servicer, where there's no trial period plan and easier criteria involved for the payment deferral. So next one, expanding on the definition of an eligible disaster. We're going to continue to require that an eligible disaster be either a FEMA declared disaster area where individual assistance is available, and that can be either the place of employment or the mortgage premises. But we're now adding any situation where a damage is done to the property where there's insured loss that takes place. So that those insurable loss events are now going to also fall under eligible disaster. So a little bit of an expansion of what we consider to be an eligible disaster to include those insurable loss events. And then we also have updated our credit reporting requirements for eligible disaster so that it's going to so that the new requirements would be similar to COVID-19, where we're just having you the servicer follow applicable law and other guidelines from the credit world, which is not our world. We had previously required you to suppress negative credit reporting for borrowers impacted by an eligible disaster and who were current at the time. And we do understand these have never been our requirements. Really, it's the requirements of the people in the credit industry and the credit world. We do not feel comfortable trying to dictate how to report those in those instances, because we really don't know what happens in the credit scoring models. We don't know what happens behind the scenes. We don't want to be responsible for potentially harming borrowers we're trying to help, and we're trying to get out of that space. So we won't be having those requirements in place any longer. And now pretty much across the board, our requirements are to just follow the law and CDIA guidelines and FCRA, and in the event of COVID, the CARES Act, and if there were to be any additional laws for disasters, you'd follow that too. For the COVID-19 and disaster servicing updates and clarifications, these things kind of are some topics that are involved with really both COVID-19 and disaster in some cases. But we updated the servicer incentives for Extend Mod and Cap and Extend Mod. As I said, those are both being retired. So this is really kind of just to cover all our bases. We are matching what we have in place for the payment deferral for any Cap and Extends or Extend Mods with trial period plans started on or after August 1st. This is in line with the same chart that we published in last month's bulletin that updated our requirements to change the Flex Mod to $1,000, introduce the payment deferral across the board at $500, and to introduce the $1,000 life of loan incentive cap. We will continue to monitor and analyze our servicer incentives and work with FHFA on potential changes at some point in the future. That will be an endeavor that involves a lot of analysis, and it's not something that it will be expected to change anytime in the very near future, but something that we will continue to look at over time. Okay, insurance loss proceed disbursements for borrowers impacted by COVID-19. We have a lot of borrowers who were current at the time that they went into a COVID-19 related forbearance. And for those borrowers, there might be subsequently a disaster event, a hurricane, something along those lines where damage to the mortgage premises occurs. And our current requirements for disbursements of loss proceeds are related to delinquency status at the time that the insurable event occurred. So at the time, in other words, in time of the disaster or whatever the event may be. And so what we're doing is providing additional coverage for COVID-19 related impacted borrowers in these instances, so that if they went onto a forbearance and they were current at the time that they went into the COVID-19 forbearance, then they would be treated as current for the purposes of that process, the loss insurance disbursement process. And that will be true as long as they are still on the active forbearance or on an active repay plan or on an active trial period plan at the time. And so we really are treating these borrowers in the same way as we would under a disaster scenario, and we feel that that's more appropriate. That the delinquency was caused only as a result of this national pandemic. They should be treated as though that they were current, just like other impacted borrowers were for disaster situations. For EDR reporting, we're just letting you know that if the borrower was impacted by COVID-19 and you're reporting the 032. And then subsequently that borrower gets impacted by a disaster, but is still actively impacted by COVID-19, is still delinquent as a result of that COVID-19 related hardship. Don't switch the reporting code to 034 for disaster. Keep reporting the 032. There are, of course, certain additional advantages to the 032 and to that hardship reason, such as the CARES Act protecting the borrowers so that their credit is reported as current. And also it's just a smoother process for the borrower to just be looked at as under the one hardship reason, and for that hardship reason to continue to be the same one that actually caused the delinquency. Lastly, a clarification on escrow shortage repayments for COVID-19 and then also disaster payment deferrals. We weren't overly specific with how we described this with the COVID-19 version of the payment deferral, but if there is an escrow shortage identified either at the time you're completing the payment deferral, or if you don't do an escrow analysis at that time, whenever the next escrow analysis takes place, you will enter into this repayment period for that to make up the escrow related to the shortage, and you can do that for up to 60 months. And that's the part that we needed to clarify, that period can last for up to 60 months. So for additional information on that bulletin, please go to the actual bulletin 2020-28 for full details. Okay, then we also issued another bulletin 2020-29. This one was much shorter, not as much information in there, but we did have some additional updates to insurable loss settlement requirements and trying to streamline things, make it a little bit easier. So in terms of funds payable, we are allowing now for the servicer to issue those proceeds via check payable to only the borrower, as opposed to other situations where sometimes you had to do to the borrower and a licensed contractor. For contractor requirements, you're no longer required to validate that the contractor is licensed or bonded and insured, so easing up that requirement a bit. For final inspections, if the borrower was current or less than 31 days at the time of loss, you will not have to complete a final inspection. And if the borrower was 31 or more days delinquent at the time of loss, there's no change to those requirements, so you still would have to complete that. For remote inspections, we previously were not permitting that, but we're now permitting it for borrowers who were, again, current or less than 31 days delinquent, provided you do so in adherence with our requirements as outlined in section 8202.11. So that was probably the biggest change in the other bulletin. We also have, as you see at the bottom, several updates related to document custody requirements, including updates related to original security instrument requirements, lost note affidavits, and clarification on insurance coverage. I'm not going to get into detail on those changes. They're all related to doc custody, and I would encourage you to take a look at the bulletin. They're all pretty straightforward and explained in the document itself. So for full details on that, see Bulletin 2020-29.
Hey, Baha, while we're waiting up to queue up the questions, I just wanted to inform the audience, one of my colleagues caught this. It says June 15th bulletins. We meant to say July 15th. We apologize for the typo. Just want to let everybody know this was the bulletins that were published yesterday, July 15th.
Good call. I probably just read it as it was because I'm Ron Burgundy.
Great. Thanks for the clarification. So with that, we'll go ahead and open the phone lines for questions. So if you do have a question, go ahead and select the raise hand icon on the right side of your screen, and we will unmute your phone line. First question comes from Paul. Paul, your line is open.
Hi, guys. Appreciate the time. Just going to ask one follow-up with EDR. You might have answered this for me in the past, but my EDR rep is just asked if I could reiterate it, please. So we process a payment deferral this month. In Workout Prospector, we bring the borrower current for August 1st. We believe from what we've read in the bulletins that, and what we've heard on these calls, that we will not have to go into EDR next month, even to put in the DDLPI. Can I just get some confirmation or clarity on that question?
So, Mark, unfortunately, if you look at the panelists here, we don't have John Felix on the call with us today. You know, John answers all the reporting questions usually. I believe that is correct. Once the loan has been brought current in the system, you will not need to report it as current in order to process your normal monthly reporting on the LLR system. So you'll just stop reporting in EDR once the loan's current.
Okay, I appreciate that. Thank you.
Great. Next question comes from Beth. Beth, your line is open.
Thank you. So I haven't been on any of these calls, and I'm new to kind of these webinars, but I apologize if this was talked about before. In canceling private mortgage insurance, and maybe they're towards the end and their date is up for the 78%, and maybe their last month was a deferral, are we canceling them provided that they weren't 30 days past due before the deferment, or how are we handling those?
So that is a topic we're continuing to work with Fannie Mae and FHFA to get some guidance out. Oh, sorry, Ben. Go ahead.
Yeah, hold on. I apologize, guys. I think I cut out there. Yeah, we are still talking to Fannie. Ryan's right. We're talking to Fannie and FHFA about situations regarding borrowers impacted by COVID. You know, we have specific requirements into the disaster space and how we treat the pay histories. But I think if I heard correctly, and I do apologize because my headset cut out for a minute, your question was about auto cancellation. Is that correct at 78%?
Yes.
Yes. So we've gotten a lot of these questions. I think your question's about auto cancellation and the payment deferral. So anytime you do a modification, obviously the amortization schedule changes, and therefore when you hit the scheduled 78% will ultimately change because the loan balance is changing as well as the amortization schedule. As it relates to the payment deferral, that's not the case. So with the payment deferral, the amortization schedule doesn't change. The loan balance does technically change because of how it's being, the interest and non-interest bearing. But the way the actual requirement works, the way the Homeowners Protection Act works, it says the borrower has to be current, or the borrower has to hit when the month scheduled that they would schedule to hit the 78% of the LTV based on the original value, which of course hasn't changed. And the borrower has to be current. So it's as long as the borrower is current in that month that they hit 78%, you would cancel it. If they're not, you'd cancel it automatically in the month after that whenever they become current again, if they become current again. So when you're doing the payment deferral, you've completed the payment deferral the following month, you would automatically cancel because they are now current and they've hit the schedule at the 78%.
Okay.
And sorry, we'd love to make that a little. We'd love to not have to explain it to that level. Unfortunately, I think if you've read the Homeowner Protection Act, where that complexity in there is somewhat taken out of our hands.
Yeah. Okay. That sounds great.
Great. Thank you. Next question that we have comes from Joe. Line is open.
Yes, so I'm clear on the with the disaster deferral. You said there's no trial period plan. So would that mean that if they're in a forbearance, they could go straight? They could defer the payments at the end of it when it becomes available?
Yeah, that's right.
Okay.
So there's no trial period plan. So what you would do as the forbearance is nearing its end is that within 30 days of the end of the forbearance plan, if you're able to make contact with that borrower, then you can approve them for the payment deferral while you're talking to them. When make contact with them, settle in our systems, and then as of the first of the following month, they'd be back to current, and the past due payments would be in the non-interest bearing deferred balance. So it's very seamless, quick transition to get the borrower back to current.
Okay, and how many times can that disaster deferral be done? Like, for instance, if they were deferred 3 payments, they get back on track, and then this pandemic continues to spread and they fall back behind again, could they do it again where the accumulated total isn't more than 12? Or is it
So we allow one payment deferral for COVID-19, so one COVID-19 payment deferral for life of loan, one disaster-related payment deferral for each disaster scenario. So if it's a different disaster event, then it would be kind of restarting. And then under our regular payment deferral in the guide, which is just the 2-month version, we allow one of those as well. This is all on a delegated basis. So that means that, if you do come into a situation where you think it makes sense for a second one, let's say maybe there's 2 borrowers and one of the borrowers had the initial financial hardship related to COVID, but then later on the other borrower did. Well, you can always submit that to us and ask for an exception. But on a delegated basis, we would only permit one for each of those hardship reasons.
Okay, one COVID and one disaster for each disaster. Okay, and I had another question on the escrow shortage about spreading it over 60 months. Mm-hmm. For subsequent years, because you still have to run the analysis every year, would you just continue to set it at 60 months, or would you decrease it each year, like 48 months, 36 months? Because you're still going to have 48 months worth of shortage, when you run it.
So, I think each analysis would be treated independently, although, you would combine the amounts if there's a period of time where there is a combined amount. But I think you would look at it like you're still making up the shortage that you identified that you spread over 60 months is still kind of, I think, accounted for as part of that repayment plan. And you would leave that alone, so to speak. And then if you were to identify another shortage that falls outside of the solution you've already kind of entered into, like let's say 12 months later, in addition to the plan you already have in place for 60 months to make up for that shortage, now there's another shortage, then you would treat that independently, and you would combine, like let's say you did a 12-month repayment period for that shortage, you'd combine that into just escrow every month, but you'd evaluate them almost as if they were separate.
Okay, so we did the 60 months, and say it raises it $100 a month. We would add the 100 to it for the full 60 months, but then each year add or subtract depending on whether the past year had a shortage or a surplus to that. Essentially, treat them as separate, basically.
Yeah, so you'd still have that 60-month plan in place, and you wouldn't need to like recalculate that shortage, but you would kind of factor that into your analysis.
Okay. All right. Thank you.
Sure.
And hey, Baha, before we take the next question, seeing some notes here, the Q&A and gotten pinged directly. Just want to go back to a couple questions regarding the first question that we got around EDR and payment deferrals and on the timing. I just want to be very clear here that I think the question was, once the loan has settled, the payment deferral has settled, once the loan is current in both your system and Freddie Mac's system, do you need to continue to report to EDR the following month? And the answer is no. If you have completed a payment deferral but it's not settled, and by not settled I mean the loan has not been brought current in your system and in Freddie Mac's system, then you would continue to report the H6 code within the EDR system, which is the new code we told you to start reporting for those, what we'll call the processing month of the payment deferral. So make sure that if the loan is still showing up as delinquent when you go into to the gateway or however you're seeing your Freddie Mac reporting, that you're going to report the H6 code for that month. If it has already been brought current, if it is settled, then you can stop reporting EDR. Just wanted to make that clarification in case there was any confusion.
Great. Thanks, Ben. Next question that we have comes from Maria. Maria, your line is open. Hey, Maria.
Oh, can you hear me now? Sorry.
Yep, we can hear you.
Okay. So my question is regarding late charges. If there were late charges, not the ones during like this forbearance period, but there were late charges 3 years ago, are all late charges to be waived or just the late charges during the forbearance period?
So I think you're asking specifically about the payment deferral, and for the payment deferral, all late charges must be waived, not just the COVID-19 forbearance plan.
So even if they were 10 years ago?
Correct.
Okay, thank you.
And Ryan, just to add, that's not just for the payment deferral, that's for the loan mods as well. Right? Anytime you do a loss mitigation solution, payment deferral, loan mod, short sale, deed in lieu, all late fees are waived as part of those transactions.
So any loss mitigation options, or you waive all of them? Okay, thank you.
Great. Next question comes from Mark. Mark, your line is open.
Good afternoon. This is actually David Norton. I'm in with Mark in his office. I'm the Chief Credit Officer at my bank here in Rockford, Illinois. What my question has to do with, and if I can preface it a little bit before, that it certainly appears that Freddie is being quite accommodating and doing everything that you possibly can to try to keep customers in their homes and keep loans current so that when we get out of this pandemic event, customers will be able to continue on with their mortgages and retain their homes. However, there is one component of this that I just am struggling with and have a question about, and that is, and it ties a little bit back to one of the earlier questions, that there is no trial period after the payment deferral time period is over with and the due dates get bumped and the loan is brought current. But Freddie has thrown a roadblock into that from the perspective of when the payment deferral program ends, the customers are not eligible to refinance their loans until they have made 3 trial payments, and then they would be eligible for a refinance at that point. And I am wondering, why has Freddie instituted that policy? Because it is completely contrary to everything else that we are doing to try to help these customers. A refi would only do the one simple thing of lowering an interest rate in today's economic environment and lowering the monthly payment so that they would stand a better chance of being able to retain their house. So my question is, why has Freddie done that? And is Freddie doing anything to address eliminating that anytime soon? Because it is a severe roadblock to what we're trying to accomplish here today.
Sure. So I think on that, and again, Ben mentioned on a different question that we don't have necessarily the experts here to address certain topics, and originations like refis are not necessarily what we do, but we can still comment on that. So I think, we are attempting as an organization to make things easier and to help borrowers and make exceptions for borrowers in many different ways, and refinances is no exception to that. So, I mean, typically they would be looking at delinquency history and excluding loans that had been on forbearance at all or that had missed payments recently from our refinance requirements. So what they're doing is they're waiving those more stringent requirements and trying to make them easier on borrowers whose delinquency was caused by a COVID-19 related forbearance. And so, we are allowing even in certain instances delinquent borrowers to refinance. And as you mentioned, in those cases, they do want to see some payment history as the borrower transitions back to being able to overcome their hardship and make their mortgage payments, which really is the intention of a trial period plan for a loan modification, where a borrower has what we call a permanent hardship and isn't able to just go back to making their regular payments and needs a modification. We require that 3-month trial period plan. So it's consistent with our ideology in that space as well. But with the payment deferral, you're getting that borrower back to current, and they are not, because there's no trial period plan, going to be excluded from the ability to do a refinance. They would just have to establish, that they can make those payments after the payment deferral if they were to do that by making consecutive payments, just not as part of a trial period plan. So, I mean, I think we're still getting to the same place, but really, with the payment deferral, it's intended for people that are delinquent to get back to current as fast as possible, and that's what we're doing, and we're trying to eliminate the trial for that reason. With the refinance, though, you're still going to have to make those payments whether you've gotten back to current or whether you're on a trial period plan. It's just that they're trying to, I think in both cases, trying to make a process easier. It's just, we have a different focus in loss mitigation as opposed to the focus of a refi, which is an origination.
Within a loan modification, the trial period is that the customer needs to make those 3 trial payments, but it's at the reduced mortgage payment amount. Mm-hmm. And with the refi situation on COVID-19 payment deferral arrangements, they're being forced to make those 3 payments at the old mortgage payment. So it's not really an apples to apples comparison when you look at it that way.
So let me jump in for a second on that one. It
seems to be that lowering a customer's monthly payment provides them a better opportunity to continue on with their payments anyways.
And that's a really great point. And if you're working with a customer who says, I can't afford that payment deferral payment, whether it's now or whether it's in a refi, then you should move to the modification, especially if you know that you're going to wind up refinancing them once they make their 3 trial payments at a lower payment than what they currently had or what they had prior to the pandemic. So, what that would tell me in loss mitigation underwriting is if a borrower says, I can't afford those payments, and that's why I'm going to ultimately need a refi, then FlexMod is your solution, not the payment deferral. And you would be able to refinance them once they've made those 3 trial plan payments. In terms of where you're going before, just to add on to what Ryan was saying, just not to belabor the point, but it is a different scenario. One thing to keep in mind, I know one reason why our credit policy team and Fannie Mae's credit policy team and the government regulators all came up with that solution for the refinance is, there was a concern, at least, a couple months ago, that a borrower would be put into a payment deferral, brought automatically current, and then without ever making a payment, go into a refinance. And then what happens if the borrower doesn't actually make the payment? You're going to originate a loan. You're going to have nowhere to put it except back to the GSEs with a fairly significant loan level pricing adjustment because the loan will now be in forbearance because it was never really in the right solution to begin with. So we wanted to avoid that aspect of having to get to a point where we're relitigating the whole issue of a borrower being in forbearance at the time the loan has to be delivered to Freddie Mac or Fannie Mae. So that was a big part of that make your 3 payments push, to make sure that when we refinance these loans and have a new loan, that we're not having to deal with those pricing adjustments again.
If you do a flex modification, can you do it at today's market interest rates, or how is the interest rate determined on a flex mod? Because that's part of the problem. If we have customers who are 4.5% and 5% interest rates, and interest rates are at 3% today.
FlexMod is based on the market rate. It's based on the four-week average of the primary mortgage market rate. So it is actually if the borrower had a 4 or 5% rate, it would certainly get lowered as a result of a FlexMod.
And at the end
it's a rate that we publish on FreddieMac.com. So it updates regularly. So make sure you bookmark that page.
All right. And at the end of those 3 months, then the customer could refi out of the FlexMod into another loan, but it would be at the market rate, whatever it is at that point.
Provided they're eligible for the refi with all the different conditions on the front end side of the business, yes.
All right. So the end answer to this question is that 3-month deferral period followed by payments is because of the pricing adjustment if the customer doesn't make any payments after that point. Right?
Yep. Yeah, and just to add a little bit more information, the current FlexMod rate as of today is 3.25%.
3.25?
Right.
Okay.
Great. Thank you, Ben.
Right.
Thank you, Ryan.
Right. And if I could take up even more time, and I apologize for that, there was a question asked earlier about payment deferral time periods and how many COVID-19 related deferral arrangements a customer could have. Within the answer that was given, it didn't really define how many months a COVID-19 payment deferral can be arranged for. And I think the CARES Act indicated that a customer could defer up to 12 monthly payments within the COVID-19 relief options. Was the answer meant to say that you can, how many months are you thinking that we can provide payment relief for?
So the forbearance plan can go for up to 12 months regardless of delinquency. The payment deferral, which is a transition from the forbearance plan that suspends payments, is intended for borrowers who really only became delinquent as a result of the pandemic and who are back to their normal circumstances, able to make their payment. So we do require that the borrower have been current or just one payment past due as of the national emergency declaration or national emergency effective date on March 1st. Correct. And we will allow up to 12 months of delinquency for a borrower to remain eligible for a payment deferral. You can defer 12 payments.
Right, and that has to be and maybe that's what the answer was. It has to be a consecutive 12 months. So if you did it for 3 months, the customer resumed payments and then applied for another COVID-19 forbearance, you couldn't do that, but as long as you are consecutively deferring 12 payments, you can go up to 12 payments. Is that right?
So it doesn't necessarily have to be consecutive. It's as long as if you were current on current or one payment past due as of March 1st, and I'll just give you a scenario. Let's say you went on 6 months of forbearance, and for whatever reason you fell out of the forbearance, and then 2 more months went by. Maybe you made payments, maybe you didn't, and then you went on a second forbearance plan for another, let's say, 3 months. And then you actually were ready to transition out, but you've never had a payment deferral. Then at that point, you'd still be eligible for the payment deferral despite the gap because you were current as of the start of this pandemic. we don't necessarily require that you ever be on forbearance as a result of your COVID-19 related hardship, as long as it is a COVID-19 related hardship that caused the delinquency and that you are current or only one payment past due as of March 1st. So hopefully that answers your questions on that and the payment deferral, and then if so, Baha, can we go to the next question?
All right. Thank you very much for your time.
Sure. Thank you. Next question that we have comes from Rob. Rob. Rob, your line is open.
Hello. Thank you for taking my call. We have a few loans that were delinquent less than 31 days as of March 1st, the effective date of the National Emergency Declaration, but they have not made a payment since and have since become inactive. If the borrower enters into the payment deferral program and their DDLPI is brought current, do they become active again on Freddie's books? And part two, if they have, would any interest not remitted to Freddie due to the inactivation become due to Freddie when the loan is brought current?
So the payment deferral, the way to look at it is it's a full reinstatement essentially. It's just a different way of getting there. And so, once the loan's inactivated and the servicer's no longer remitting the interest to Freddie Mac, but the interest is still accruing, the borrower is still becoming further behind on principal. The payment deferral takes let's say it was 6 missed payments. So you had remitted for the interest, and then for the final 2, didn't remit anything to us, and the borrower still owes principal and interest on all 6. Well, all 6 of those payments where the borrower owes the principal and interest get applied to that non-interest-bearing deferred balance, and we then will reimburse you, the servicer, for the 4 months of interest remitted to us, and the borrower ultimately owes us all 6 P&I payments, but they owe it to us in a different way, and now they are current and reinstated and active.
Okay. Is there a bulletin or a guide that I could refer to specifically to get more information on that?
Yeah, it's 2020-15.
Okay. COVID-19 payment deferral.
Right, and then yesterday, 2020-28 is the disaster version of the same thing.
And then, actually, on that note, thanks, Ryan. On that note, Baha, I think on the next slide, we were going to talk about some of the training sessions that we have that talk about a lot of these types of things in more detail as well. So as you can see on the screen, these are a bunch of the webinars that are already on the schedule. We look to continue to schedule more of these. But take a look at the times and go through FreddieMac.com at the Learning Center to sign up for these. And these are, I think, 2-hour training sessions on different topics, everything from settling and workout prospector to underwriting a payment deferral, how all of these things work together. Really great resource in addition to the bulletins that we put out there. And the trainings, we have other materials as well. There's another slide that we can get to at the end as well. But a lot of stuff on the different web pages at FreddieMac.com that talk about all of the different nuances of how all the systems work together, in addition to the policies and programs that we put out there.
A follow-up question: would we get that interest back through a DAR adjustment?
Yes.
Okay. And may I indulge you for one more question?
Sure.
Okay. Is this statement still true from the February 12th Freddie Mac Single Family Seller Service Guide? It was in section 8303.4C, and it has to do with a borrower repaying their deferred balance. It said, quote, if the partial repayment of principal is less than the interest-bearing UPB, it must be applied to the interest-bearing UPB. If the principal curtailment is equal to or greater than the interest-bearing UPB, then the principal curtailment must first be applied to the deferred UPB. and any remaining curtailment to the interest-bearing UPB. I know that's a lot, but is that still true?
Yes, it is. Now, we've talked about on this call before that we do systematically allow you to apply money, proceeds directly to the non-interest-bearing balance, for those exceptional situations where your borrower absolutely demands that it is. It shouldn't be the rule. They'd want to pay down their interest-bearing balance first, typically. But we do allow for that. We do have a field in the LLR file. But other than that, yes, that is absolutely correct. If the amount is less, they make a curtailment that is less than the interest-bearing UPB, you apply it there. If it's more, then you'll apply it to the non-interest-bearing UPB first. And the reason for that is that, we've actually experienced situations on our book where that was not done properly, not done correctly, and the interest-bearing portion, i.e. the portion that you're making monthly payments over, has now been paid off, and the balloon is not due for another couple years. And we hold the loan on our balance sheet that no payment is coming in, but still has a balance. That's problematic. Obviously, it's problematic for you as well. That's why the rules work that way.
Okay, thank you very much.
Great, thank you. Next question comes from Sabrina. Sabrina, your line is open.
Good afternoon, everyone. I have one question that two, but one that just brought up by one of the announcers on the call. So with regards to COVID, it said current or less than 30 days delinquent. So let me ask this. As of March 1st, if a customer was due for February 1, in that case, due date of last paid installment would have been 1/1/20, do they qualify for the no-doc, let's say deferral, doesn't matter. You were doing extend and then you're going into the deferral. So my question is, if they were due for February, did they qualify for the no-doc workout?
Yes, absolutely. And let me also say that we were never a big fan of the less than 31 days delinquent language and pushed to have that changed. We did not win that discussion for the COVID-19 payment deferral, but if you look at the disaster version, you'll notice it says less than 60, which was always our intent. And
okay.
So what we really mean is just current, or it can be a full month past due, and we consider anything less than 60 days delinquent to meet that.
Okay, great, because then we need to go back and do a couple things. So here's my other question, because this is happening. I'm actually in Ohio. So everyone knows that the COVID-19 cases are going up. We've had several customers who were on a forbearance, now have a solution, and they wanted to know what if. Now, I've been doing this for over 25 years. I would think that if a customer is again coming back and saying, yes, I've been affected by COVID, my job is closed down, that we would want a package. But I heard people talking earlier, and we can put a non-delegated case in for a deferral. But my question is, should we or are we required to do a full package, or is this going to be another no-doc if there is another round of closures?
So I think it would depend on because generally speaking, your question's about an exception request, right? So generally speaking, we need to see the justification. Now, practically speaking, we don't always necessarily need that BRP if you really have a case you can make without the documentation for why this makes sense. But you're going to have to determine whether that is the case, because the guide does require that you submit a complete BRP to ask for an exception. But again, in practice, there are situations where you can submit that without getting the BRP, but use your discretion to make sure that that's the right decision. We start requests that are going to get denied. I mean, you can make a logical case, and if you believe that that is the right case, then our system will not prohibit you from making that request.
Okay. Because I'm just finding, because the CARES Act said that customers initially have 6 months and then they can go into another 6 months. For customers who only requested 3 months, then, like I said, had a solution, comes back, they're wanting that additional time. So my thought was, prove it that you are, prove it that you are having another.
I'm going to walk back my previous response. I thought we were talking about something different. It sounds like...
No, you answered that too. That was part as well.
You can approve up to 12 months of forbearance for a COVID-19 impacted borrower, regardless of delinquency, no matter how many terms you end up giving them. So if it's 3 months and then 3 months and then 3 months and then 3 months, you're delegated to do that. You don't have to ask for permission. And the CARES Act is pretty clear that if the borrower asks for 6, you must give them 6.
Correct. So what if they have a solution in between? That's the question. Is that, we call them 30 days before the end of the FORB. So they were supposed to start making payments July 1. We contacted them in June. They state, yep, I'm back to work. I can pay. We send them out their solution. They execute it. They get it back to us. Their account's now due for July. They call back July 16th. Yeah, I thought I was going back to work, but I'm not.
Yeah, so, okay. So I think you cut out for a minute there, so I got a little bit nervous because I thought you were saying you're going to deny a borrower a forbearance plan. No. Now that makes much more sense, and I get it. And, yeah, I mean, we only, on a delegated basis, permit the one payment deferral for COVID, so you would need the exception. And, again, you can use your discretion to determine how best to get that approved.
Okay.
Yeah. Hey, Ryan, let me add in just real quick. First off, if the borrower calls you July 1st and says, I'm back to work, I'm good to go, and before the end of the month they call and say that's not the case, well, they just extend the forbearance, right? You don't have to settle that solution, right? You can just extend the forbearance at that point. We get to different months, it gets, obviously, operationally, it's going to be impossible to do that. I will say, we've gotten this question a few times, and, our belief is that the CARES Act does not contemplate a situation that involves a period that everything gets better and then gets worse again economically, and our policy doesn't as well. So right now, like Ryan said, it's one shot. Everything else is an exception. If we do ever see this point where the economy opens back up for fully and then has to shut back down again, and this type of thing happens again, we'll have to be more reactive to that. We don't have answers to, that's kind of a little bit too much of a what if right now.
Great. Thank you, Ben. Thank you, Ron. Thank you, Sabrina, for the question. Next question that we have comes from Allison. Allison, your line is open.
Yes, I was just wanting to clarify because when y'all were speaking earlier about the rate on FlexMod, y'all were saying that it's the market rate, and I want to clarify because my understanding is that if they are below 80% LTV, that it's not the market rate, it's their current interest rate.
That is a good point, and that is true. It is the full waterfall for the FlexMod is for borrowers who have an LTV ratio of greater than 80%, and that is the 3.25%. And then for a fixed rate mortgage that has that much equity and is a less than 80% LTV ratio, we don't provide interest rate relief as part of the modification.
Okay, thank you. That's what I thought. I just want to make sure. Kind of threw me through.
That's an excellent point. Right.
Thank you.
Great. Next question that we have comes from, I think their hand just went down. All right, I think we got most of the hands raised. Again, if you do have any questions, go ahead and select that raise hand icon located on the right side of your screen, and we will unmute your phone line. All right, looks like we have a question from Mary. Mary, your line is open. Hey, Mary.
Thank you. This is Mary Ann Canfield from Playback. I have a question in regards to MI cancellation as it relates to borrowers on a COVID forbearance. So if a borrower is on a COVID-19 forbearance plan and becomes delinquent and submits a request for borrower requested MI deletion, from our standpoint, they do not meet the delinquency requirements as reflected in the guide, that they not have any missed payments. So we are not currently, canceling the MI in those cases, but wanted to confirm that that was Freddie Mac's intention.
That is absolutely correct. There is never, ever a situation where a delinquent borrower is eligible for MI cancellation. Being current is always a prerequisite for cancellation, whether it's automatic or borrower requested. We talked about a little bit earlier on borrower requested cancellations is once the borrower becomes current, the way our guide reads, frankly, the way the law reads, would be that the borrower, if they were delinquent within the last 12 months or even more than one delinquency within the last 24 months, they'd be ineligible for MI cancellations. In the past, regardless of any of the other factors, in the past, for disasters, we have created this carve-out or accommodation that says if the delinquency was solely because of a disaster forbearance or payment plan or trial plan, then we would not hold that against them on the payment record. In terms of are we going to do that for COVID-19, that question is still up in the air. It's something that continues to be discussed between us and Fannie Mae and the FHFA. As you guys know, all of these things over the last 4 months, everything has been done in the realm of GSE alignment, and this would be no exception. Even areas we've never been aligned before, we will be as it relates to our COVID response. And so if we do provide a separate accommodation for people who become current through a payment deferral or some other means to be able to get MI cancellation before having to wait another 2 years, we'll announce that when we come to that decision. But right now we haven't come to that yet or come to agreement with Fannie Mae on that.
Okay, thank you. I appreciate that.
Great. Next question that we have, Ben and Ryan, can a borrower qualify more than once for the COVID-19 forbearance program?
Yes, as long as they haven't surpassed the 12 months of forbearance available to them. And then also keep in mind that we have regular forbearance as well, just under regular guide requirements where if subsequently there's another hardship, but that borrower is less than 12 months delinquent, then we permit just under our normal forbearance policy, the borrower to be able to get forbearance till up to 12 months delinquent total delinquency as well.
Great. Next question comes from Christy. Christy, your line's open.
So we were wondering how we would report on the EDR payments that the borrower made towards deferred payments while they're still in the forbearance period. So we've had some people that took a 3 or a 6 month forbearance and then have made payments. We're just not sure how to apply them.
Sure. So on these borrowers, have they remained current throughout it, or are they delinquent are they delinquent? I guess that's the first question.
They were current when they took the forbearance, and so are still current.
Then you would not have to report those in EDR in terms of the payment. You would report the forbearance to us even on a current loan if you place them on forbearance. The way you do that is you'd report the 09 forbearance code, you'd report the 032 as the reason for default code, and you'd report the action date as the date the first payment that would be covered under that forbearance. So you know how you have to put the forbearance plan in writing that will say, let's say the borrower calls in today and they're going to be on forbearance starting August 1st. You're going to send them a thing that says you're on forbearance for 90 or 180 days, whatever it is, starting with your payment due on August 1st. And so that 8/1 date would be the action date you report to us. So in that example, you'd report the 09 forbearance code, the 032 national emergency declaration code, and then you'd report the action date as August 1st. And then if they do continue to move the DDLPI throughout that, obviously you'd continue to report the moving DDLPI, but you would not change the reporting of the other three codes until the forbearance plan is over.
Okay. Can I ask one more question?
Sure.
Okay. If the borrower's forbearance period has ended and they've not responded to our QRPC attempts to discuss what repayment option to put them in, how do we report them? What should we do in that instance?
So in that situation, we require that if they were eligible for the payment deferral, which would mean, as Ryan has discussed a few times, they were current or have missed one payment prior to the emergency declaration, then you would proactively offer the payment deferral to that borrower based on our requirements, and that's in 2020-15, that bulletin. When you send out that proactive offer, whether the borrower has taken it up on or has still yet to respond, you would report that month. You would stop reporting forbearance, and instead you'd report the H6 code. And the H6 code is the code that lets us know that there is an offer made for the payment deferral. Okay. Now, if a borrower is not eligible for the payment deferral, you're going to proactively offer the flex mod. And in that situation, you're going to report, and Ryan, help me out here, what's the actual code? HE?
HE, yeah, you got it.
That the mod offer has been made. So you'll either be reporting the H6 or the HE, depending on which offer has gone out there.
That's helpful. We weren't sure that you would do the H6 if they hadn't affirmatively accepted yet. So, okay, thank you. Last thing, how do we get the payments back on the correct amortization schedule after the deferred payments have been moved to due at maturity? Do we re-amortize and keeping the payments the same?
Yes, you do wind up re-amortizing. So for the payments that are eventually put into the balloon, you actually amortize the balance down. So I think the way you would normally do that, and I do see that Gavin Gibbons from our servicing operations team has joined in and can probably help answer this question. But you're going to settle that in with Workout Prospector, put the different fields in. We're going to move the balance down to what the interest-bearing UPB should be. And you would start amortizing it again based off what that interest-bearing UPB is. And if I said that wrong, Gavin will correct me now. Perfect.
Thank you.
Great. All right. It looks like we're out of time. There's a few other hands that are raised, questions that we didn't get through the chat. Those folks that still have their hands raised, feel free to go ahead and just type in your question via chat. We'll take it back offline, and we will either develop it into our FAQ document or reach out to you offline. So with that, I'd like to go ahead and turn it over to Sujatha to go over resources.
Thank you, everyone, for joining today. If you just scroll down one more slide, Baha. First of all, we wanted to just, one back up. We just wanted to announce to let you all know our customer conference, which we have every year in September, is moving to virtual, and it's going to be on October 6th and 7th. So we definitely would look forward and are excited and hope you all will be able to join us. A lot of our training, a lot of the topics that we think are essential to help you guys do business with us will be covered. So we're really excited if you could join. So definitely look out for that. And then, as Ben mentioned earlier, the next slide, Baha, please. Please do review the COVID resources webpage. There is a lot of information on there, job aids and FAQs, as well as all our links to our bulletins. Definitely read through a lot of information out there for you. Avail yourselves to those resources, please. And thank you for all that you do. Thank you, guys.
Thank you. And with that, I'll actually turn it over back to Don to go over closing remarks.
Thanks, Baha. Thanks, everyone, again for participating. It's very helpful, good questions, and thanks to the panelists for spending time answering those questions. And just in final comment, many of you may have received a servicer readiness questionnaire or survey late Thursday or Friday of last week. If you did receive that, we would very much appreciate it if you could fill that out. It's a very brief questionnaire. It won't take you more than a couple minutes. It would be very helpful to us as we look how to serve your needs better. So thank you again. Have a great day, and hopefully we'll see you on the next call.